Hello and welcome to our February webinar covering the USDA crop report and other developments. We've certainly had a lot of developments happen, and it's been a wild ride here since Inauguration Day with headlines coming out 24/7, just about every day of the week and just about every hour of the day. We start to wonder if our president ever gets any sleep. But while I'm talking, why don't I put up the disclaimer slide here for you? And let me say also that if you have any questions during the presentation, you can put them in the Q&A box, and we'll try to get to those questions at the end of today's presentation. But let's talk about this. First of all, again, price is a function of supply and demand as modified by the flow of money. So let's start out by talking about that money flow and what it's doing right now. And I wanted to open up just taking a look at our economy. We saw Federal Reserve Chairman Jerome Powell testifying to Congress this morning, to the Senate Banking Committee today. Tomorrow he'll testify to the House Financial Services Committee. That's something he does every 6 months. And he said we basically have a solid economy, and we have basically full employment. And he's not in any hurry to make another interest rate cut. And I would agree with that. I think he's gone too far already. But as we look at restaurant bookings, they're strong. TSA air travel data shows that airplane travel is strong. Daily debit card data shows strong consumer spending. The Atlanta Fed's GDP now is showing 2.9% gross domestic product growth in this first quarter. The Fed's weekly GDP index is at 2.5%. Both of those are solid numbers. Retail sales are strong. They'll get updated for the month of January on Friday. We'll get inflation numbers at the consumer level tomorrow morning, and inflation data at the producer level on Thursday. Jobless claims numbers continue to be relatively low from a historical standpoint. Hotel occupancy rates are strong. Bank lending to firms and consumers are just kind of going sideways. No real red flags there. Bankruptcy filings, the same thing. Credit and debit card data is solid. Gasoline demand is strong, meaning people are driving. Broadway show attendance is strong. Box office weekly grosses are strong. S&P 500 forward profit margins are at record highs. Business formation is weak because of a lot of the uncertainty right now with the Trump administration. And ASA temporary worker staffing index is weak. Employers are hanging on to employees. They're not hiring a lot of new employees, but neither are they laying them off. Layoffs are very low. And so it's just kind of hang on to the good employees you have. Don't let them go because it's hard to find new ones. But we're not expanding either. We want to see how this tariff situation plays out in the end and what that'll impact. We saw the small business optimism index come out this morning with a little bit of dip. It's still solid, but it's starting to show a little bit of concern. And as the National Federation of Independent Businesses said, businesses are still optimistic, but they're dialing that optimism back just a tad. So let's move forward here. Unemployment rate, 4%. That's historically a strong number. If we look at the consumer price data, and like I said, this will be updated tomorrow, and the first of the year is typically a time when we see inflation adjustments go up, because that's when businesses make adjustments to prices for the new year, and including also make adjustments in wages. And so it's not unusual at all to see inflation expectations go up. Keep that in mind when we get to our StoneX commodity index tracker. As we look at the CPI as how it's tracking versus this historical range in the 60s, 70s, and early 80s, it's just uncanny, the parallel here. Does that mean we have to go back up there toward 15% like we did in 1980? No, absolutely it doesn't. But human behavior does tend to repeat itself, so it's something we need to guard against. And in fact, Federal Reserve for a couple of years kept saying, we don't want to make the same mistake we made in 1980 by cutting rates too soon. And then they cut rates. Does that mean that we're going back up? Not necessarily, but let's keep an eye on it. Now, let's look at our fiscal debt. The Trump administration has developed the Department of Government Efficiency, known as DOGE, for cutting government spending. Our national debt is at $36.46 trillion dollars. Let me add a few more zeros onto that. $trillion, as you see up here in the upper left-hand side. There we go, got that circle kind of drawn there. If you look right over here in the middle at the top, we see that estimated tax revenue this fiscal year is a little over $5.02 trillion. And the interest in servicing our debt is currently at $1.043 trillion, which is more than we spend on defense and war. Now, 1.66 trillion on Medicare, and in Medicaid, 1.486 trillion on Social Security. You add up these four categories of Medicaid, Medicare, Social Security, defense and war, interest on the debt, and it comes to around $5.05 trillion. So we're already at deficit spending, and we haven't even touched the discretionary areas of the budget. The rest of them, like USDA, Veterans Affairs, Department of Education, and I could go on and on. Homeland Security, we haven't even touched those. And if you look at total spending in the current budget, it's right at $7.186 trillion, if you see this number right here. So far, the clock shows that the DOGE has cut about $80 billion. Their original goal was to cut $2 trillion from annual spending. Then they lowered it to $1 trillion. They got a ways to go if they're going to get there, but we're just in the first few weeks of their work. So we'll continue to kind of track that and see where it's at. Now, if we look at what's been happening with 10-year yields, they've been going up since September 17th when USDA started cutting its benchmark rate, which is the opposite of what they typically do in a rate cut cycle. And a lot of it is because of that runaway fiscal spending, fiscal debt that is starting to squeeze the credit markets. So if we look at it overall and summarize the bullet points, we currently have a continuing resolution to fund the government till March 14th. We still have to deal with the fiscal spending debt cap, which we're at that now. We hit it as it was reestablished on January the 1st. So Congress needs to act on that. That'll likely be part of the continuing resolution to fund the government going forward. But we're having a lot of disagreement in Congress on how to proceed on both of those issues. Now, we have seen the credit rating agencies in previous years, recent years, warn that if they see political inability to find a solution, that does risk a credit downgrade. And if that happens, that raises interest rates for all of us. The steepening of the yield curve that I indicated is a signal coming issues. Now, it's pulled back here in recent days, but trying to go back up again. Weakness in treasury auctions could occur without warning if investors are drawn elsewhere. And we have seen occasional auctions where that has happened, which took us up to around 4.6 or a little bit higher on 10-year yields. And as I mentioned, DOGE is currently cut so far around 80 billion or so, and that number is still constantly changing. That's tied to the commodities now. So on the right-hand side, you see the 5-year break-even inflation rate trending higher. And with that, we're seeing commodity prices kind of trending higher as well. A little bit of pullback in recent days, but overall kind of trending higher. If we look at it versus the 2-year break-even inflation rate, we're seeing a stronger push in inflation expectations there. Now, over 1.5 percentage points now for inflation expectations going up with the 2-year break-even inflation rate. And so we'll continue to track that. How does it compare to the CPI? The CPI continues to trend sideways to lower, but we are seeing commodities as a whole kind of trending